You know, 2.5 years ago, few people could have foreseen the carnage that ravages our securities markets today. Back in the spring of 2000, the equity bubble had not yet burst. Stock prices were at an all-time high. IPOs were being poured out of Wall Street at the rate of more than one a day. America's investors had increased their exposure to the equity markets to the highest level since September 1929. The dot-coms were supposedly transforming the world. A new high-tech driven economy was supposedly to create permanent prosperity, driving stock prices ever higher. Pension funds and 401k accounts were flush, enjoying great returns. Do you remember when you traveled and you went through the airport and saw the magazine articles about how everybody was going to retire in their 50s based on their stock portfolios? You know, I can't help but remember Professor Irving Fisher's famously ill-timed remark in mid-October 1929 that stocks have reached what looks like a permanently high plateau, and I expect to see the market a good deal higher in a few months. A remark that would haunt that good and decent man for the rest of his life. Well, even in those halcyon days of the late 90s, there were a few of us, and we were viewed as cranks at the time, who warned that underneath the veneer of prosperity and profit actually lay widespread accounting rot, falsified profits, inflated asset values, and executive chicanery that would ultimately shake the system. Shakespeare wrote long ago, "Oh, how courtesy would seem to cover sin." And so did a great bull market cover financial sin, at least for a while. But collapse our markets did. First it was the dot-coms, but then the virus spread quickly to more respectable companies. We have seen a massive market decline, leaving our NASDAQ looking disturbingly like the Japanese Nikkei index. I would remind you that that index has now been declining for 20 years, a decline due to the phony accounting, lack of accountability, and systemic dishonesty that epitomizes the Japanese financial and legal system and ultimately simply destroyed investor confidence in that country. Here in the United States, accounting write-offs totaling $148 billion erased all the profits purportedly reported by the NASDAQ companies during 1995 through 2000. According to the Wall Street Journal, the companies currently listed on the market that symbolized the new economy, in fact, haven't made a collective dime since 1995. And that article was written before the billions of dollars of additional write-offs taken by Enron, WorldCom, Quest, AOL Time Warner, and Adelphia. Nor do these figures factor in the shameless abuse of public companies in refusing to account for stock option expenses as the compensation expense that everybody but them knows it really is. Ploys that overstated corporate earnings by additional billions of dollars. In truth, much of the reported profit of corporate America during the late 1990s were nothing but illusions. They were false pictures painted by insiders who pocketed billions of dollars for themselves by selling off the corporate stock that they got through options at inflated prices and pocketing billions more in cash bonuses based upon corporate earnings that were falsified in the first place and later eliminated through restatement. No wonder our NASDAQ not only looks like the Nikkei of recent years, but look how it compares to the Dow Jones Industrial Average of the late 20s and early 30s. To try to understand where we are today, Let's go back a little bit in time and see how we got here. In the wake of the great 1929 crash, Congress had hearings that exposed the rawest type of self-dealing, abuse, and fraud by corporate insiders, the Wall Street banks, and the big accounting firms. Congress quickly passed the Securities Acts of 1933 and 1934. These laws, which really constituted the high water mark of the new Roosevelt administration's campaign for financial reform, created the Securities and Exchange Commission to oversee our markets, required that accountants be independent public watchdogs with a public trust, and required truthful disclosure by public companies and prohibited insider trading. As time went by, these federal laws, along with private lawsuits by investors, helped to restore accountability to our system and built investor confidence. In time, the money came out from under the mattresses, and our markets became the envy of the world, the richest, deepest markets in the world, where foreign investors wanted to place their money and where foreign companies wanted to come to raise capital. But the political alignment of 1994 produced the first Republican majorities in both houses of Congress in many decades. Sensing their first opportunity to roll back the securities laws, corporate interests, the accounting oligopoly, and their Wall Street friends descended on the new Congress with a massive lobbying campaign to seek enactment of what would ultimately become known as the Reform Act, or Securities Reform Act, of 1995. Demand for passage of this act was greased by millions and millions of dollars of lobbying fees and political contributions from corporate interests. This tsunami of special interest money was flavored by anecdotal tales of woe by corporate executives who whined about how frivolous class action lawsuits by avaricious lawyers, that was me, resulted in blackmail settlements which injured public companies and undermined economic growth. Well, after a bitter, long and bitter political fight, the 95 Act was enacted over President Clinton's veto by just 1 or 2 votes. And it was nothing more than the worst rollback of investor protections in the United States in the 60 years since the securities laws were originally enacted. But the proponents of the reform legislation promised that if the legislation they wanted was enacted, capital formation would be enhanced, employment would increase, and American investors would actually benefit from having their legal rights curtailed. But in fact, what happened was quite the opposite. Just 5 years after the corporate lobbyists got Congress to gut the federal securities laws, curtailed the ability of investors to hold corporate shenanigans accountable, guess what? There's been a massive upsurge in securities fraud in the United States. As I say, the chickens have come home to roost. The results are now clear for all to see. Every metric to measure fraud has soared. Financial scandal after financial scandal has surfaced. The huge market bubble has burst, leaving investors holding a multi-trillion-dollar bag. Layoffs have skyrocketed, capital formation has collapsed, reality has overtaken deceit. You know, it wasn't as if Congress wasn't warned. Testimony from countless consumer and investor groups and many editorials warned that a drastic cutback on investor protections would grant those best positioned to profit from stock manipulation a license to lie and result in a massive upsurge of fraudulent conduct and investor losses. Also in the mix here is the failure of the Securities and Exchange Commission, the supposed cop on the beat, to do its job. Despite a remarkable public relations campaign casting former SEC Chairman Levitt as an investor's champion, the truth is, after the SEC was turned over to that alumni of Wall Street, the SEC was anything but aggressive in cracking down on financial manipulation and executive insider trading. Next, the SEC was headed by a lawyer who actually championed the passage of the 1995 Act and represented the big accounting firms. Early on, he signaled a gentler relationship with the accounting profession. And he took the remarkable step of having corporate executives swear that their financial reports were accurate. Hello, Earth to Harvey Pitt. The securities laws have required corporate executives to present truthful financial statements to investors for 60-some years. Now Harvey Pitt's gone, and the SEC is again now to be headed by yet another alumni of Wall Street, William Donaldson, who, while in private life, has been sued for securities fraud on more than one occasion and vehemently opposed several of the SEC's most investor-friendly initiatives. How many foxes are we going to put in that chicken coop? Listen to what financial writer and economist Ben Stein said. The worst stock market debacle in the history of post-war America did not happen by chance, but because of greed, conspiracy, and incredible ignorance by those in high places, and a federal regulatory failure of unique proportions. What happened did not happen by accident, and a full accounting is owed to the people who have been fleeced. But you know, while America's investors have lost trillions of dollars, corporate insiders, their accountants, their friends on Wall Street, have done quite well for themselves. Grieve not for the investment bankers who pocketed billions of dollars of fees while foisting worthless dot-com securities on the public, while rigging the IPO market so that their insiders could quickly flip out and make huge profits. Grieve not either for the accountants. With the demise of Anderson, their immensely profitable worldwide oligopoly remains intact, with even less competition for the so-called Final Four, whose practices will now be even more profitable, even though their fingers are all over countless financial frauds that cost investors trillions. And grieve not for the corporate executives. They pocketed billions of dollars in stock option sales and billions more in cash bonuses based on falsified profits, making a mockery of our nation's laws against insider trading. Whether they were driven by greed or by envy, and it was probably both, it is clear now that an increasingly lavish, no, not lavish, crazy stock option compensation system incentivized corporate executives to do whatever, and I mean whatever, had to be done to make their numbers every quarter to meet Wall Street expectations. So they could hit the earnings targets, the stock would stay high, they could exercise their options and trade out of the stock. Insider trading in this nation reached almost incomprehensible levels in recent years. Cisco's insiders sold $605 million of their stock before that stock collapsed from 82 to 10. JDS Uniphase insiders sold $1.9 billion, that's right, $1 billion of their stock before write-offs eliminated every dollar of profit that company had ever reported, and the stock went from 159 to 3. Quest's insiders only sold off $2 billion worth of stock before that stock became, as we say, a hat size. Enron's insiders were sort of pikers, only $1 billion of insider trading there, unloading their stock at as high as 85 a share. But I must say that my friend Larry Ellison at Oracle really takes the cake, selling $900 million worth of his Oracle shares just a few weeks before Oracle, a financial forecasting software company, announced a major revenue and earnings shortfall that crushed the stock and from which the stock has not yet and never will recover. And let's not forget the most recent example, AOL Time Warner, the worst merger of the century, where in the 5 weeks after the merger closed, and while promising investors 50% cash flow and 30% earnings growth for as far as the eye could see, the insiders voted with their pocketbooks and unloaded $500 million of their own stock, while at the same time spending $1 billion of AOL Time Warner shareholder money to buy back stock on the open market to support it while they were bailing out. Most recently, we've had the disgraceful example of prestigious immunologists selling off millions of dollars of their InClone Systems stock and tipping their relatives and friends to do the same after learning that a defective new drug application to the FDA was going to be rejected. And while the arrests in InClone have made a lot of headlines, I must remind you that of the billions and billions of dollars of illegal insider trading profits that we've seen in recent years, not $1 has yet been disgorged by the government. And you know, it's not just insider trading. Executive compensation and perks got completely out of control with pay packages that bear no relationship to actual corporate performance. Corporate treasuries have literally been looted of billions. Remember, when crime pays, you get a lot of crime. Simply put, the behavior of many corporate executives has been abominable in what we call the new corporate kleptocracy. There is no excuse for these highly educated and respectable people to engage in this greedy and dishonest behavior, while so many Americans, ordinary people, work so hard for so little. Many of us can't help but contrast the selfless courage of the unionized and modestly paid fire and police workers of New York City on the morning of September 11 with the selfish avarice of corporate executives, many of whom had not even yet arrived at work that morning in their chauffeur-driven limousines, while those extraordinary, ordinary people were down on the street, risking and giving up their lives to save fellow people. But you know, corporate executives need help to pull off many of the things that they do. They need help to cook the books. The accountants, corrupted by huge consulting fees that dwarf their auditing fees, have helped falsify corporate profits. And they've turned our beloved generally accepted accounting principles, and that's called GAAP, into cleverly rigged accounting ploys, and that's called crap. We also now know that the accountants have been a lot less independent than they were supposed to be. According to the SEC, it turns out that Waterhouse, presumably the most prestigious accounting firm in the world, grossly violated the independence rules. All 12 regional partners of Waterhouse that oversaw that firm's independence program violated it. 31 of 43 members of the firm's board of directors violated the independence rules. 86% of the partners in Waterhouse violated that firm's independence rules. Think about those numbers. They are shocking. Shocking, especially since the SEC in its investigation concluded the firm made, quote, little or no effort to comply with independence rules. And for this transgression, Waterhouse paid the SEC a fine of $7 million, approximately 2 hours of Waterhouse's annual revenue. It is no wonder that the accounting profession has thumbed its nose at the SEC for so many years. We also had an unbelievable IPO boom driven by the Wall Street bankers, which in retrospect really amounted to little more than a massive wealth transfer from investors to venture capitalists and dot-com entrepreneurs, from the sale of stock in companies that have turned out to be worthless. Stock offerings that were all accomplished by grossly false forecasts of future revenue growth and profitability, forecasts that were immunized from legal liability by the gutting of the Securities Act in 1995. And Wall Street has a lot to answer for their securities analysts, who it turns out were in on it all along, as we had suspected, getting paid in return for boosting the price of stocks that were investment banking customers. You know, to be a stock analyst in the 1990s, at least a successful one, you had to have the word sell removed from your vocabulary, and you had to learn to put lipstick on pigs. There's a fundamental problem in our legal and financial systems. There's not enough individual accountability. If Enron's and WorldCom's insiders walk away with millions of dollars and their portfolio of mansions and ski homes intact, what will it matter if their reputations are ruined? And what will investors think? A lot of people are willing to have their reputations ruined and spend a few years in a country club facility at the expense of the taxpayers if they can put $100 million in their pockets. I know some that would do it for a lot less. I often think of a cartoon I saw years ago. You're going to see it now. Two prisoners are in the jail cell there, and you see the one saying to the other, you know, it turns out those generally accepted accounting principles weren't quite as generally accepted as I thought. Corporate executives and their accountants should keep in mind the old biblical admonition: what would it benefit a man to gain the whole world and lose his soul? Or I might add, his freedom. Deregulation has benefits, but it has costs as well. I'm really concerned that in this country, investor psychology has suffered a blow from which it may not recover for who knows how long. Strong markets, those of you who are economists understand, depend upon healthy investor psychology. If you don't have that, you get the money under the mattress syndrome. I fear that's what's happening in our markets today. More and more investors find 0.5% money market returns a lot more appealing than the equities of WorldCom, Enron, Dynegy, Xerox. You get the point. We have to face a hard fact. The history of American finance remains the history of financial fraud and of chicanery. And while it is true that most entrepreneurs and financiers in every age are honest, periodically the fraudsters and the charlatans gain prominence. Excesses rage, and burned investors shy away from the markets. We're seeing that today. One last point. Enron and WorldCom are colossal corporate governance failures. We have got to do something to improve corporate governance in this country. The Sarbanes-Oxley Act is a very modest but unsuccessful step in that regard. And what investors are now learning is, as bad as the 95 Act was, they now have to step up to the plate and try to protect themselves. Congress wanted large investors to become more active enforcing the securities laws when they passed the 95 Act. At first it didn't happen, but then a trickle became a stream and a river and now a flood. Pension funds all over the United States, both public and private, are stepping forward to call corporate executives, the Wall Street banks, and the accounting firms to account. Why? Because the pension funds had the most at stake and have lost the most. You know, I spend a lot of time with institutional investors, and they're furious. Their pension funds are being killed. You saw in the paper this morning, our own pension fund here in San Diego has plunged into underfunded status, and in no small part it's due to the losses that have been suffered in the securities markets. When you combine the state budget crises that are afflicting states all over the country, and of course our own, with the fact that the large public pension funds are now virtually all in grossly underfunded status, I want to tell you something. There's a big iceberg coming into view, and it is a doozy. And it's going to be a big public policy problem for people to solve. What are we to do? There are no easy answers. It will take years and years for memories to fade and for investors to return to the markets. But one thing we can do, those of us who are public trustees or fiduciaries to money can stand up, fight for the rights of their beneficiaries, try to hold corporate executives accountable. As someone said, it may be good corporate governance at the point of a gun, but it's still good corporate governance. If, as seems certain to me, corporate America refuses to respond voluntarily by substantially improving their governance structures and cleaning up their act, they're going to be spending a lot more time in a lot more courtrooms against a lot more enraged investors. Thank you very much.